Ever wondered what the difference between an ETF and an ETN is? Well, you're about to find out. These two types of investments, while similar in name and often used interchangeably, are quite different in their structures and the way they function in the investment world. ETF, or Exchange Traded Fund, and ETN, Exchange Traded Note, are both types of exchange traded products, or ETPs, that trade on national securities exchanges. They share similarities in the way they are traded, just like stocks, and can be bought and sold throughout the trading day at market prices. These similarities, however, are just the surface of these complex investment tools. Delving deeper into their differences, the first and most significant one lies in their structure. An ETF is a type of investment fund and exchange-traded product indexed to a collection of securities, such as stocks, bonds, or commodities. Think of it as a basket that holds a variety of different investments. On the other hand, an ETN is a type of unsecured debt security. This means that ETNs are backed by the issuer, typically a bank, and not by an underlying pool of assets. Essentially, when you invest in an ETN, you're buying a promise from the issuer to pay you a certain return. The risk profile of these two investment tools also differs. ETFs, being backed by an actual collection of assets, have a risk associated with the performance of those assets. ETNs, however, carry an additional risk. They are subject to the creditworthiness of the issuer. If the issuer goes under, the investment could be lost. Taxation is another area where ETFs and ETNs differ. ETFs are subject to capital gains tax, which is triggered when the ETF shares are sold for a profit. ETNs, on the other hand, do not incur capital gains until the investment is sold or matures. This can be a significant advantage for those looking to defer taxes. When it comes to dividends, ETFs generally pass these on to the investors, whereas ETNs do not pay out any dividends. Instead, the value of the ETN when it matures or is sold takes into account any potential income payments. So, in a nutshell, while ETFs and ETNs may seem similar at first glance, they are quite different in their structure, risk profile, taxation, and treatment of dividends. An ETF is like a basket of investments, indexed to a collection of securities, and has a risk associated with the performance of those assets. An ETN, on the other hand, is a type of unsecured debt security, subject to the creditworthiness of the issuer, and does not pay out dividends. Remember, understanding these differences is crucial when deciding which investment tool best suits your financial goals and risk tolerance. Knowledge, after all, is the most valuable investment you can make.